Okay, so picture this. You're at this big real estate investment meeting, right? You've got all these seasoned pros around you, and you want to make a smart move.
Right.
You don't want to be that person who's caught off guard.
Yeah, you want to look like you know what's up.
Exactly. So that's where today's deep dive comes in.
I like it.
We're going deep on how those Fed interest rate changes you hear about all the time, how those actually affect your commercial real estate decisions.
Makes sense.
And to guide us, we've got this insightful article from Allies.
Oh, I know them. They're a great firm.
Yeah, they really know their stuff.
Definitely.
What I found really interesting is how they use history to kind of set the stage.
Yeah, they do a good job with that.
It's like they're saying, look, you can't just look at the numbers in a vacuum.
It's bigger than that.
You got to see the patterns from the past to understand what might be coming next.
Exactly. History can be a powerful tool when you're trying to predict the future.
Right, and they start way back with the Great Depression.
Wow, that's going way back.
I know, right? But there's got to be a reason they went there.
Oh, there is. And it's incredibly relevant even now, almost a century later.
Really?
The Great Depression shows just how much the Fed's decisions can impact real estate.
Okay, I'm listening.
Back then, they had these tight monetary policies, and that actually made the Depression's impact on property values even worse.
Oh, wow. I didn't realize it was a double whammy like that.
It was businesses were failing left and right. Properties lost their value. Foreclosures went through the roof. It was a tough time.
Yeah, that's a sobering reminder that even real estate isn't immune to what's happening in the larger economy. Exactly. You got to look at the whole picture.
Right. So then we move on from the Depression. Things start looking up after World War II.
Right. The post-war boom. Everyone's feeling good.
Exactly.
Oh.
And that optimism, it's reflected in the commercial real estate market, too.
For sure. And the Fed played a key role in that.
How so?
Well, they kept interest rates nice and stable, which created this predictable environment where businesses felt comfortable expanding.
Makes sense.
Demand for property shot up. It was a great time to be in real estate.
Sounds like a golden age.
It really was.
But then the article jumps ahead to the early 2000s.
The housing bubble.
Exactly. We all know how that one turned out.
Yeah, not so good.
And it's interesting because they're kind of drawing a parallel to today's market.
Right. Because what seems like cheap money can come back to bite you.
That's what they're saying. The Fed slashing those interest rates might have seemed like a good idea at the time.
Right, to stimulate the economy after the dot-com bubble burst.
Exactly. But it ended up fueling all this risky lending, and that played a big role in the housing market crash.
So it's like a temporary fix that creates a bigger problem down the road.
Exactly. And we see this again after 2008.
Right. Another crash, another round of near zero interest rates.
Yep. The Fed steps in, tries to help the commercial real estate market recover.
Which they did to some extent.
They did. But it makes you wonder, did they actually contribute to the very conditions that caused the bubble in the first place?
It's like using a Band-Aid to fix a broken leg.
That's a good way to put it.
It might help in the short term, but it's not a real solution.
Not at all. And it's this constant balancing act for the Fed.
Between stimulus and stability?
Exactly. Yeah. Every move they make has huge consequences, especially for real estate investors.
Absolutely. So just as things were starting to get back to normal after 2008, bam, the pandemic hits.
Another curveball.
Right back to those near zero rates.
Déjà vu all over again.
It's like we're stuck in this loop. And didn't commercial real estate react in a similar way to 2008?
In a lot of ways, yeah. Some sectors did well, others not so much.
Right, like industrial spaces and multifamily housing, they held their own.
Exactly. They were resilient.
But office spaces,
not so much.
Which brings us to the million-dollar question for anyone looking to invest right now.
The big one.
The Fed is signaling that rate cuts might be coming.
Okay.
But what does that actually mean for you, the investor?
Yeah, that's the question, isn't it?
That's what we're here to find out.
Let's dig in.
Okay, so let's unpack it. What happens when those rates go down?
Yeah.
The article talks about the immediate impact starting with lower borrowing costs.
Right.
Can you break that down for me? What does that actually look like in the real world?
Sure. So let's say you're trying to finance a new office building, right?
Okay.
Lower interest rates, that means lower monthly payments on your loan.
Right, which frees up some cash.
Exactly. You've got more capital on hand to maybe reinvest in the property.
Ooh, like renovations.
Exactly. Maybe attract some bigger clients. Those lower rates, they give you some breathing room financially.
It's like the Fed is giving you a little bonus just for being in the real estate game.
Kinda, yeah.
Yeah.
And this is where understanding cap rates comes in.
Cap rates. Okay, now we're getting into the technical stuff.
It's important, though. The article explains it really well. It's basically a measure of how profitable a property is.
So a higher cap rate more profitable?
Actually, it's the opposite.
Oh, really?
Yeah, a lower cap rate usually means a higher property value.
Interesting. So if rates are going down, does that mean it's a good time to sell?
It could be. It definitely favors sellers.
But buyers need to be extra careful.
Yeah, they got to look for those properties that are actually undervalued.
Find those hidden gems.
Exactly. Now, here's the thing. The article makes a really good point.
What's that?
Not all properties react to these rate changes the same way.
Oh, interesting. Give me an example.
Sure, they use net leases versus short-term leases.
Okay, I've heard those terms, but I'm not totally clear on the difference.
So with a net lease, the tenant takes care of most of the expenses. Property taxes, insurance, even maintenance. It's common for things like industrial spaces, those big warehouses. Short-term leases are more what you'd expect. Apartments with year-long contracts, stuff like that.
Okay, so why does it matter what kind of lease it is when rates go down?
Because of how it affects the landlord's income.
Okay.
So the net lease, the landlord's income is pretty much fixed.
Because the tenant's covering most of the costs.
Exactly. So even if rates drop, they might save a bit on new debt.
Right.
But their overall income doesn't really change much.
Makes sense. What about short-term leases?
That's where things get interesting. See, with short-term leases, landlords have more flexibility.
Okay, I'm listening.
When those contracts come up for renewal, they can adjust the rent.
Take advantage of the market.
Exactly. If demand is high because of those low rates, they can raise rents and make more money.
So it's about having the flexibility to adapt.
Precisely. Short-term leases give landlords more agility in a changing market.
Got it. But, the article isn't all sunshine and rainbows about these rate cuts.
Right. There are some things to watch out for.
Like inflation.
Exactly. It's easy to get caught up in the excitement of lower rates.
Cheaper money time to buy.
Right. But here's the thing. Cheaper borrowing doesn't mean much if everything else is getting more expensive.
True. It's like those buy one, get one 50% off deals.
I know exactly what you mean.
You feel like you're getting a steal, but if you didn't need that second item, you're not really saving money.
Exactly. That's inflation at work. Construction materials get more expensive, labor costs go up, property taxes rise.
Suddenly, those lower borrowing costs aren't looking so great.
Not so much. Your profits can get eaten away even if you got a good deal on the property itself.
And wasn't the article drawing a connection between this and asset bubbles?
Absolutely. That's the danger with prolonged periods of low interest rates.
Like what we saw in the 2000s.
Exactly. It can inflate prices beyond what's reasonable. People start buying based on speculation, not actual demand.
And that's how bubbles are formed.
Exactly. And we all know what happens when bubbles burst.
And it's not pretty when those bubbles burst.
Not at all. Anyone who bought in at those inflated prices is going to feel the pain.
So the takeaway here is don't get blinded by the hype.
Exactly. Approach those rate cuts with caution.
It's like you got to balance the excitement with a healthy dose of realism.
Exactly. It's about informed optimism, not just jumping in head first.
So for listeners out there who are maybe on the verge of a big real estate decision.
Yeah, big decisions.
What's the one thing they should keep in mind above all else?
I'd say don't let the fear of missing out cloud your judgment.
That FOMO is real.
It is.
Yeah.
But you got to do your research, understand the market, and most importantly, get advice from people who've been there before.
Right. This isn't the time to go it alone.
Exactly. You need a good team in your corner.
And that aligns with what the Allies article emphasizes too, informed decision-making.
Absolutely. Especially in real estate.
It's a complex world out there.
It is. You got to know what you're getting into.
Well said. So we've covered a lot of ground today.
We have. From historical patterns to those all-important cap rates.
We've seen how even small moves by the Fed can have huge ripple effects on real estate. And we've learned that sometimes the best deals are the ones you don't make.
True. Sometimes walking away is the smartest move.
Absolutely. Now, if this deep dive has got you thinking, which I'm sure it has.
It's hard not to think about this stuff.
I know, right? I highly recommend checking out that full article from Allies. It's got even more great insights. But before we go, one last food for thought.
I like it. Hit us with it.
We talked about how different types of properties react differently to rate changes.
We did.
So which type do you think is going to be the most volatile in the coming months?
Ooh, that's a tough one.
It is. And why? Let us know your thoughts in the comments. And until next time, happy investing. Get in touch with Allies Commercial Realty at info@alliescommercialrealty.com to find your ally in commercial real estate.